Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to give you a presentation that I made and performed for a group over the weekend. I gave this presentation about talking about the current state of our economy, what was happening to it, and what can be done about it. Namely speaking, I'm talking about inflation itself. And in this presentation I'm not trying to give you death by PowerPoint or anything, but I do want to go over with you the slides that I did share with my presentation and hopefully enlighten you on some of the effects that government policies are having on our economy and what can be done to change the situation and bring the inflation rates down. It's not just monetary in nature, it's fiscal as well. I'll start off with a quote from Thomas Sowell. "The first lesson of economics is scarcity. There is never enough of anything to satisfy all those who want it. The first lesson of politics is to disregard the first lesson of economics. And truer words have never been spoken." As government continues to grow larger over time, the economy continues to grow weaker. This red line is a measure of government spending as a percentage of nominal GDP. The green line is a measure of private sector spending, so it's GDP subtracting out government expenditures. And as you can see here, the nominal percentage of growth rate has gone down as government percentage of GDP increases. So in other words, as government grows larger, the economy grows weaker. This is the annual government spending report that I pull from governmentspending.com. On the left is the 2021 government expenditures. On the right is the 2019. You can see here that in terms of total spending, government expenditures have increased by about $2.4 trillion. This was almost exclusively in the federal budget. So it's been the federal government spending that has been increased over the last 2 years, and this is about on a total basis, this has increased government spending annually by 33%, and this is resulting in a huge increase of a whopping $4.8 trillion of extra government spending. A lot of this has been concentrated in the welfare sectors. Nearly 50% of this increase is in welfare, but it's not just welfare, it's across the board as well. There's been general government that has been increased by $250 billion. That's the bureaucracy that has been enacted for COVID. There's been transportation industries that have been growing up because Pete Buttigieg can't get enough money to spend. And then there's this general other spending category, which in my opinion probably encompasses unemployment. That has been spent on that. And the 2022 budget is looking a little bit better. It's looking that the federal spending is to drop about $800 billion, which will bring total spending down to about $9.3 trillion from $10.1. So that relative drop of about, say, 8% will have a little bit of a deflationary impact on our economy as far as prices are concerned. But it's been this increase in government spending that has been driving up prices because the total amount of money that has entered into our economy has increased by about roughly, say, $6 trillion, maybe a little bit more than $6 trillion as measured by M2. Nearly $5 trillion of that has been spent by our government. So nearly 80% of the inflationary impacts that we are seeing is being caused by extra government spending, especially when it goes to unproductivity. As a result, federal deficits have exploded. The Fed has monetized this debt by printing money and buying bonds from banks. So what happens is that the government sells bonds to banks. Banks buy those bonds, and then the Fed prints money and buys it. That's how they're able to get away with this, because typically speaking, it's supposed to be illegal to monetize this debt, but it's doing this using the banks as the intermediaries. As a result, the federal deficit, which doesn't even include interest paid on the debt, which is certainly set to go up as interest rates climb, has reached nearly $3 trillion over the past 2 years. That will probably see about $2 trillion deficits this year, and that's going to have a higher interest rate impact on our economy that I'll go into in a little bit. The money supply has jumped and prices have started to escalate in the past year. Price inflation is starting to become entrenched as a result, as we can see in the rising annual year-over-year change in the Consumer Price Index in red. Let's compare this to the money supply in blue. Sure enough, Milton Friedman's observation has proven true. We saw this huge jump in M2 in 2020 going into 2021, and it wasn't until about a year later that we start seeing the annual increases in the CPI. And so judging by this, probably for the remainder of 2022, we will more than likely see a building CPI annual inflation rate as this money comes washing out into the economy, and will probably push price inflation up to 9, maybe even 10%, combined with geopolitical tensions and rising commodity prices, namely in that oil. So if this continues, we're going to be looking at a repeat of the 1970s. Waiting lines at the gas stations and supermarkets are soon to follow, which is what we saw in the late 70s under the presidency of Jimmy Carter here. Last year, I made a presentation similar to this one, and I believed that things would play out much as they did in the 1970s. So far, that's mostly held true. The one exception here is that price controls have not been enacted by the Biden administration, but that's probably because the Republicans who have split the Senate and control a vast minority in the House would have stonewalled those kinds of actions right now. And so instead, we've just skipped this price control element, and now we're already into the shortage wage price control spiral going on that's happening right now. Wages are starting to pick up, which is starting to pick up prices, which is going to force businesses to borrow more money, which is going to force more money to be created. More money comes out into circulation, more people spend it, and the prices just escalate from there. The big question is, of all this, and this is the reason why I'm giving you guys this data, is what can we do about all this? What can we do politically or fiscally or monetarily that can be done all this? Well, essentially there are 3 routes that I think we can take in society in the US. Option number 1 is to let the Fed take care of it. Now, if we go this route, the way that the Fed would take care of it would be to raise interest rates and raise the cost of borrowing to a point where it becomes too expensive to borrow money at these rates to continue to finance expenditures, forcing people to save money. A forced savings effect takes place, draws down on consumption, and the economy goes into recession. But there's a problem. As the Fed has lowered interest rates over time, the economy is now holding a whopping 2.5 times more debt now than in 1980. And I cited 1980 because this was the last time that the Fed did this and succeeded in taming rampant inflation. Back then, Paul Volcker had to raise interest rates all the way to 20% because the inflation rate was at 15%. And in so doing, he instigated 2 very bad, very sharp recessions, but the economy recovered after that because the inflation rate was brought down and the forced savings allowed to finance profitable investment projects. But that's not really doable now. With inflation at 7.5%, that would mean that the Fed would need to raise the federal funds rate to about, say, 8 to 10% just to start really dropping down those interest rates. Drop those inflation rates. Because if the Fed doesn't, what pervades throughout society is a realization that interest rates are negative. When interest rates are negative, you're technically getting paid to borrow money. Why sit there and save money when it's not yielding you enough interest to keep up with the inflation rate? You're losing wealth by doing this. Well, the reverse is also true. Borrowing money at a lower interest rate than the inflation rate means that you're gaining wealth by doing so because the debt, your liability, is being cheapened, and what you can use to finance those expenditures with is getting more expensive. Paying for that now versus later means that you're avoiding a higher bill, which is what causes inflation to spiral out of control and what makes negative interest rates so dangerous here. The Fed really can't do this now because if they raise rates back up to 8 to 10%, it's going to crash the markets, very similar to what Paul Volcker did, except the debt load is so huge and so unsustainable, and everybody and every business, every sector of the economy, every household has become so dependent on debt, this would result in the next Great Depression. Defaults and delinquencies on loans will continue to rise after they have been dropping from the COVID pandemic, and they have been dropping back down to normal levels thanks to ultra low interest rates. But once they reach a point, once these defaults and delinquencies reach a point, it will cause the economy to spiral into recession, and we possibly could get a drawdown on bank accounts to the point that it may cause a run on banks, because consequently, while people and businesses will be drawing down on their accounts, which the banks are already creating loans off of, the government is drawing down on bank accounts through record deficits, levying out bonds to those banks. And what's been keeping the banks from collapsing has been the Fed buying those bonds. But what happens when the Fed sells the bonds back to the banks, and the government's selling bonds back to the banks, and corporations and people are drawing down on their accounts and not replacing their accounts with new money that they're earning from producing because the economy is going to recession, could result in a catastrophic collapse of the credit bubble and a collapse of the entire banking system. Consequently, the stock market bubble, which has been forming for the past 12 years, will also burst. And by my estimate here, comparing the gross private product, that is gross domestic product minus government total expenditures, to the Wilshire 5000 price index, this stock bubble is worse now than what it was in 2008 or in the 2000s with the dot-com bubble, and is comparable to the bubble that we saw in 1929. So the result will most likely be a run on the banks, a Great Depression, and hey, we're all going to be waiting in line at the soup kitchen for our coffee and donuts. So that doesn't really seem very much of a wonderful, rosy scenario here. Perhaps we shouldn't take option one. Well, what's option two? Well, we could keep inflation. Hey, maybe inflation's not so bad. Maybe this 7%, we can just eat it and stomach and have 8% of our wealth drain away every year in terms of nominal earnings. Except it never stops there. Once inflation becomes entrenched, especially at lower interest rates, it just spirals out of control. It starts to increase and feed on itself as people increase consumption. Essentially, a psychological effect takes place. People realize that if the price of stuff is going up and they're not earning more or not able to, make more money to pay for that at a sufficient rate, they're going to go ahead and rush and buy those goods now to avoid paying the higher price in the near future. Once that becomes ingrained inside society, the bottom right picture, which is a picture of Venezuela, is the ultimate result. People take all their cash, they start buying as much physical goods as possible, and we have empty shelves and empty storages and empty grocery stores and empty supermarkets, which then destroys the entire productive capacity of business because there's no investment into producing those goods. And we end up getting rampant poverty. We end up getting martial law instituted when people revolt against the government, blaming the government for the policies, and the government blames greedy business for the policies, and everybody's just frustrated and starving to death, and we get a lot of chaos that goes on in the streets. Ultimately, there's a third option to take. This one is ironic because economically it's the least painful, but politically it's the most unfeasible, and that's to cut government spending. Remember how I told you that it's not just monetary in nature that's been driving this? What's been driving the increase in the money supply has been the record fiscal deficits that the government's drawn upon. So then if the driver of the monetary printing has been primarily government spending, then the reverse is also true. Cutting government spending will inadvertently cause a reduction in the growth of the money supply, which will cause prices to drop. Not only that, whatever new increases of money comes out goes to the private sector, which can actually be used for productive purposes, versus the government sector, which tends to waste resources. There have been 3 instances of high inflation in the U.S. in the 20th century. The most obvious one and the most infamous one is the inflation crisis of the 1970s, but there were 2 other times that the U.S. faced high inflation, and you may not have known about this because they were relatively short periods of time, and nobody really talks about them, and there's a reason why. It's during the World War II, when we had high inflation thanks to war spending, and right after 1945, post-war. And then it is post-World War I, and ironically in post-World War I, we were also hit by a pandemic as well. That was the Spanish flu. The inflation rates hit and peaked as high as 24% in 1920, And in 1947, the inflation rate was forcing itself close to 20%. It was about 19% at its peak. Let's take a look at World War II right quick. In this case study, government spending was a whopping $100 billion out of a GDP of $228 billion. So in other words, government spending was about 45% of the economy. Okay, let's compare that to the 2019 budget when government spending was $7.5 trillion and GDP was about $21 trillion. By that estimate, government spending was just a little bit over 35% of the economy, and that was already pretty high. But here it was 45%, much like what the $10 trillion government spending is now compared to our $23 trillion nominal GDP. That's about 45% of the economy. And sure enough, we had rampant inflation in 1945 and 46 and 47 as soldiers came home to spend money. But lo and behold, government spending was cut by a whopping 50% in 2 years. And so when we take a look at the inflation rate, in 2 years, by 1947, the inflation rate plummeted here. So there, we knew that the culprit, as it usually is the case with high inflation, is high amounts of government spending that is financed by monetary printing. So when governments finance their debt through money printing, which they usually do to avoid higher interest rates, we end up getting price inflation as the result. And it was a miracle. People have jobs when the government is cut. Contrary to the popular belief of many economists of the time who predicted doom and gloom from all the cuts in government spending, the economy boomed soon thereafter and America became a world superpower. We became the economic giant monolith of the entire world here. Take note here that even though the nominal GDP rates increased over 2 years while government spending was cut, originally in 1946, this GDP number actually dropped, but it never dropped by the amount that government spending was cut. Therefore, the private sector actually expanded both years, despite the fact that we had high inflation, we had a recession that followed soon after that in 1949. This recession was very much overlooked because when the inflation rates came down, the private sector was allowed to boom thanks to savings, forcing up growth in the business sector of the economy. World War I, a similar effect took place. Here, the budget of 1919, government spending was $23 billion compared to a GDP of $79 billion. So that's about 27 to 28% of the economy, which was the highest amount of government spending percentage of the economy at that time. In 1921, the U.S. economy went into recession. Notice how the GDP numbers dropped by $5 billion, but government spending was cut by over $12 billion. There, government spending was slashed by 60%. And what happened? The private sector technically expanded. So when government is cut, the private sector expands. When the private sector expands, the core of the economy actually grows and you rebound. The result was obviously the Roaring '20s. We got out of that from containing that inflation the proper way by cutting government spending. You actually get booms in the economy. The lesson's pretty clear on that is that government spending doesn't really add anything to economic growth. If anything, it takes away. So the question is, who do you trust out of all of this? Do you trust the federal officials who last year were telling you not to be worried about inflation, but instead to be worried about economic growth? Or do you trust the private sector officials such as Steve Hanke, an economist, or Jeffrey Gundlach, an investment hedge fund manager? They were both predicting inflation in the spring of 2021, and they were both right. So who do you trust? My answer is that you need to be trusting these guys. These people know exactly what they're talking about. They're warning of higher inflation, and these people do not. They were thinking that without further action of monetary and fiscal stimulus, we're going to have a bad economy. In reality, it's been the fiscal and monetary stimulus that's made our economy so bad, and it will only go away when both are removed. It's not going to be just enough for the Fed to remove the monetary stimulus, for if it does, it's going to raise interest rates to a point that collapses our entire economy. But if the government were able to cut its spending and say to cut its expenditures back down to, say, the 2019 levels, which would require a huge drop of $2.4 trillion from the 2021 spending levels, we could then see inflation drop very quickly and normal economic growth resume and possibly avoid a very painful correction. Whatever recession we do see will be more a recession on paper and not an outright collapse of the economy. In real terms, the economy will expand, especially in the private sector. And guys, that's all that I have for today, but I did want to give you that presentation to enlighten you on that. Let me know what you think about all of this. Do you agree or disagree with my observations and conclusions? Do you think that I'm looking at this too linearly? Is there another more three-dimensional way to look at this? Or am I right on the dot with my analysis of the situation? I'd love to hear from you. Drop a comment. Let me know what you think about all of this. I appreciate all forms of comments at this point, just so long as you are not rude or insulting in anybody's economic beliefs. Guys, once again, I thank you for watching this video. If you like the content that I provide, make sure you click that like button, subscribe to my channel if you haven't already. Click that notification bell. You'll always be notified when I do upload a video so you can get amazing new content like this, or at least I think it's amazing. Once again, I thank you for watching, and I'll talk to you next time.